Hello friends, welcome to Encode Digital. How to Make Money in Stocks by William J. O'Neill is one of the popular investing books. He is also founder of Investors Business Daily newspaper. In this video, we will summarize 7 key points, which William highlighted in his book. So, let's start. The first and the main point from the book is CAN-SLIM methodology. O'Neill developed CAN-SLIM methodology, which focuses on identifying fundamentally strong companies. It is based on the analysis of both fundamental and technical factors to identify leading growth stocks with the potential for significant price appreciation. Let's deep dive into CAN-SLIM methodology. C stands for current earnings. O'Neill suggests focusing on companies that have shown consistent and preferably accelerating earnings growth over the past few quarters. Positive earnings surprises can be a good indicator of future growth potential. A stands for annual earnings growth. O'Neill suggests to consider companies with a track record of strong annual earnings growth. Look for companies with earnings growth rates of at least 20 to 25% in recent years. Consistent earnings growth indicates a healthy and thriving business. N stands for new products and services. O'Neill suggests to seek companies that offer innovative and unique products or services. Look out for companies that have a competitive edge or are disruptive within their industry. Companies with new products or services often have the potential for rapid growth. S stands for supply and demand. O'Neill suggests to analyze the supply and demand dynamics of a stock. Look for stocks with strong demand from institutional investors and a limited supply of shares. Higher demand and low supply can create upward price pressure. L stands for leader or laggard. Focus on market leaders within their respective industries. O'Neill suggests investing in companies that are leaders in sales, earnings, and stock price performance within their sector. Leading companies often have a competitive advantage and are more likely to continue their upward trajectory. I stands for institutional sponsorship. Pay attention to the level of institutional ownership in a stock. Look for stocks that are being accumulated by institutional investors, such as mutual funds and pension funds. Institutional sponsorship can provide increased liquidity and stability to a stock. Finally, M stands for market direction. Consider the overall market trend when making investment decisions. O'Neill suggests investing during favorable market conditions, typically a confirmed uptrend. A positive market environment increases the chances of individual stocks following the overall market trend. That summarizes the CAN-SLIM methodology. To implement the CAN-SLIM methodology, investors typically start by using stock screeners to identify stocks that meet the criteria outlined in each of the 7 components. Fundamental analysis is employed to evaluate earnings growth, sales growth, profit margins, and other financial metrics. Technical analysis techniques, such as chart pattern analysis and moving averages, are used to identify optimal entry and exit points. Which brings us to second key point of the book: technical analysis. O'Neill emphasizes the importance of technical analysis in stock investing. He suggests analyzing stock charts and price patterns to identify optimal entry and exit points. O'Neill introduced the concept of cup with handle and double bottom patterns as potential buying opportunities. Third key point from the book is fundamental analysis. While technical analysis is crucial, O'Neill also emphasizes the need for solid fundamental analysis. He suggests analyzing a company's earnings growth, sales growth, profit margins, and return on equity to identify strong companies with potential for future stock price appreciation. Next key point from the book is cutting losses and risk management. O'Neill stresses the importance of cutting losses quickly when a stock is not performing as expected. He recommends setting a predetermined stop-loss level to limit potential losses. O'Neill suggests that successful investing is not just about buying the right stocks, but also about managing risk effectively. Fifth key point is emotional discipline. The book highlights the importance of emotional discipline in investing. O'Neill emphasizes the need to control emotions, such as fear and greed, which can cloud judgment and lead to poor investment decisions. He encourages investors to stick to their strategies and avoid impulsive actions based on short-term market fluctuations. Sixth takeaway point is market timing. O'Neill emphasizes the significance of market timing in stock investing. He suggests paying attention to the overall market trend and investing in stocks during favorable market conditions. O'Neill suggests that investing in a bear market is riskier and recommends focusing on stocks that outperform the overall market during a bull market. This brings us to seventh and final takeaway point from the book, which is continuous learning. O'Neill encourages investors to continuously educate themselves about the stock market and the investing process. He suggests staying informed about economic trends, industry developments, and company news to make informed investment decisions. That summarizes the key takeaway points from the book, How to Make Money in Stocks, by William O'Neill. I hope you liked the video. If you would like to see more such informative videos, then subscribe and stay tuned. See you guys next time.